Talk with Mark, where today, because I'm going solo again, we're going to talk about what I know best, which is mortgages. A lot of times we have guests on here talking about different things, but we're going to stick to some basic information, really not so much basic, because we're going to kind of expand this conversation in areas that most people don't think about when they're getting a mortgage. And I've identified 10, 15 ideas here that I want to kind of review with you. So if you are looking for a mortgage, whether it be a refinance possibly, or a purchase or new construction, you may want to keep some of these things in mind and certainly talk to your lender about that. And hopefully that's going to be me. The first thing I want to kind of share with you is an idea that's been around for a while. Not all lenders offer this, but most do these days. It's kind of new to the market in a way, but not brand new, but a lot of people still aren't aware of it. And it's called recasting. Okay. And a recast means that if you were to purchase a home and you borrowed, let's say, $500,000, and then next year that you got a large bonus at work, let's say it's $100,000 bonus, and you want to take that money and buy down your loan. In the old days, you could still do that without penalty, but your payment wouldn't change. It would still be based on the amortization of the original loan. These days, because of recasting, they will reduce your payment based on the new loan amount at the same rate. It's not refinancing. You don't change your rate structure. Now, you can refinance, but this is simply an idea around recasting them. I'm doing a loan for a woman coming to Georgetown. She's retired. She lives up in the Dallas area. Her home is on this market for sale, but it's not sold yet. She's got about $300,000 in equity once she does sell it. So she's able to put down 10% on a property here in Georgetown currently. But because she's retired on fixed income and IRA income, she wants to keep her mortgage down lower once she sells her house. So I said, her name is Corrine. I said, let's do this. Why don't we buy the property now? Because be where her daughter lives and she wants to move here quickly. And then the property sells maybe this summer. You can take that equity, pay down the mortgage. I should not buy down, pay it down. She's going to be borrowing about 400,000 now. She's got about 300. She wants to keep her mortgage at around 100 grand. So we'll get her payment down from, let's say, 3,000 a month to about 1,000 a month. And she thought that was a great idea. So that's called a recast. It's really something you want to think about if, in fact, you're in a position to maybe inherit money or sell a property or get bonuses at work. Anything where a large lump sum comes into play, you can do that. And you can do it more than once. It's not a one-time offer. Usually it's at least $10,000 the lender wants to see, but anything over that, a couple times a year, they'll allow you to do that. I also want to talk a little bit about credit rescoring, because that just came up in conversation today. I was talking to a young couple that were looking to buy a house. They referred to me, never owned before. It's their first home. And her credit is very high. Her credit's like 780. But her husband, when he was a little bit younger, they're probably in their late 20s. When he was in college and whatnot, he didn't take care of his credit, and it was down around 580. And so I said, well, we can help you today, but you're going to get a much better deal if we can get your scores up to at least 640, which is around 60 points where it is today. And so I shared with them how some strategies, looking at their credit report, how they can maneuver around some debt on his side, not hers, in order to get the scores up here in the next 60 days or 90 days. They want to move this summer or at least by September. So we got a little bit of time, but not a lot. So I shared with Thomas, his name is, on how he can restructure some debt, pay down some debt. They've got some money in the bank. He just needs to get his scores up. In addition to that, I talked to her about that together. I said, look, because Karen's got great credit and she's got some active credit cards, we're going to do what they call an authorized user, where she can put you on her credit cards as an authorized user, and her credit on that account will flow into your account and get your scores up much faster. And once that happens, within 60 days, we should go to 580 to 640, or maybe even a little bit higher in the next couple months, 3 months probably. Perfect timing for them to go ahead and contract on something this summer. So again, rescoring is not that unusual. We do it all the time because not every point counts, but every tier of credit counts, because credit is a big, big part of your rate and terms. And like I told him, I said, we could do a loan for you today, but the rate's going to be not real good. I said, if you get the scores up to 640, you're going to be gold using FHA as a type of loan we're going to be looking at. So they thought that was a great idea. And I just want to mention that because there's also an idea of what they call a rapid rescore, which if you can, an example, I had a client come to me and his scores were on 720, and his name was his name was Devin. And I said, hey, Devin, look, if you pay down this credit card from $10,000 to $1,000, I can get your scores up about 40 points overnight, literally. And that's what he did. He went online to Chase and got his rescored or paid down that on that debt that he had on a credit card. And within 3 or 4 days, we what they call rapid rescore. I went from 720 to 760 and got him a much better deal just by paying down that credit card. He was going to pay it down anyway. So this was just an opportunity in the mortgage process to save him quite a bit of money on his loan just by rescoring that one account. And of course, you can also rescore other accounts too, but in his case, we only needed one. And the credit systems these days are so sophisticated. They have credit simulators where the credit bureaus basically tell us what to do, and we can communicate that to our client. And they're very, very close. I mean, they don't just make it up. They say, if you pay this thing down to $1,000, we'll get you 40 points. And that's exactly what happened. So that's another strategy people are using in the process, even during the loan process, to get a better deal than they would have known about. And that also speaks to an idea of what they call loan level pricing. There's a thing called LLPA, which is not new, certainly in the industry, but the secondary market has these benchmarks called loan level pricing adjustments. And they're usually negative adjustments based on different criteria like credit scores or down payment, type of property. And they adjust your rate based on lots of factors. So a lot of times we want to make sure that we position our client the best we can based on the fact that we have to deal with these loan level pricing adjustments. As an example, it's not uncommon if you have good credit and you put down 15% on a mortgage, it's going to be a better rate than it is on 20%. Now that doesn't seem right. You think, well, the more I put down, the better deal I'm going to get. And that is true if you put down, let's say 25 to 30%. But if you're putting down 20%, you may want to look at a 15% down payment, hold that 5,000 or that 5% back, or maybe pay points with it. Use that money wisely to maybe buy down your interest rate. Now you're going to be paying a small portion of mortgage insurance, but it shouldn't be more than about 60, depending on the loan amount, of course. It's a percentage of the loan amount. But we always often see MI, what's called private mortgage insurance, $60, $70 a month, which if you're saving $20,000 up front, that may be worth it. So again, those are loan level pricing adjustments you really want to talk to your lenders about, because those are not set by the mortgage company. Those are set by the secondary market, which is referred to as Fannie Mae and Freddie Mac, and typically speaking, in the conventional market. FHA doesn't have loan level price adjustments. If you put down 3.5%, you're going to get the same deal if you get put down 10%. So again, and they don't adjust their rates nearly as much as conventional. Like this couple that, that I was talking to today, Thomas, I said, you can go conventional because you're going to put down a good bit of money, but the rates can be much higher than if we go FHA. There's some mortgage insurance on FHA, but at the same time, you're probably going to save 1% on the interest rate, which is going to well make up for the difference in the MI. So that's the way we're going to go with those guys. The second thing, another thing we talk about a lot, and this is very common, this is not unusual in this market for sure in Austin, Texas, is seller concessions. A lot of times right now, sellers are motivated to get rid of their homes. There's a lot of inventory, and buyers are taking advantage of that through seller concessions. It's not unusual to have $10,000, $15,000 possibly paid by the seller for closing costs, discount points, certainly maybe some upgrades or repairs to the property. Those are seller concessions that can be used a variety of ways. But I had a client not long ago, actually in Kerrville, buy a property for about $1 million. He was putting down $200,000 and borrowing $800,000. We negotiated, not me, but the agent negotiated a 3-2-1 buy down to where his first year rate was going to be in the threes, because we were discounting the rate up front and the seller was paying for those points, which cost them about $30,000 from the seller, but they were anxious to leave or to sell. So they were willing to negotiate a huge discount for him in the early years of his rate, because he's got a home in Colorado he's going to be selling, and he'll be paying off this loan probably in 2 or 3 years. So he's not too worried about that, about the rates going up. He's just worried initially to get his payment down as low as possible. So again, seller concessions, work with an experienced realtor, somebody who's been in this market maybe for 10 or 15 years possibly, or maybe less than that, but who's gone through some of these cycles, because up until about 4 years ago, we were in a buyer's market, as most people, I mean, a seller's market, as most people are familiar with. And that has shifted dramatically over the last 4 years to where we're not really in a recession, or but we are in a correction in housing market, although that's changing right now. We're starting to see a lot of people move back into the market. First time buyers particularly are saying, hey, it's time. I've waited too long. I've been on the fence for 2 years now or whatever, and I'm ready to buy a house. We're starting to see a lot more activity in open houses and phone calls that we're seeing for new mortgages from first time buyers, and relocation buyers are still happening. So that's something to consider, and rates are still drifting them down 6%, 6.5% on conventional. I locked one yesterday on FHA loan with decent credit at 5.75. So the money's still pretty good. It's not as low as what I'd like to see it, but I can't complain. And that also speaks to what they call points versus not no points. Points are a function of the rate. When I talked to a guy yesterday, Trevor had called me about a loan, and he didn't realize, he thought when we had a FHA loan, it had one rate to it. I said, no, man, there's probably a point and a half spread of interest rates. And the reason that is, on any given day, and yesterday, as an example, the rate on that was he was buying a manufactured home. Now, manufactured homes are a little more risk to lenders, so the rate's a little higher on FHA for manufactured homes. Instead of 5.75, yesterday I could get him 6.125. So he's paying a little premium because of the type of property. That's sort of a loan level adjustment in that world, because because it's a little more risky, at least lenders think it is. So I got him 6.125, what's called par rate. A par rate means there's no points to that loan. And he said, well, the payment was still, it wasn't the payment so much he was concerned about. It was the cash out of pocket, because of the closing costs and the prepaids. He was a little short of cash. I said, well, why don't we do this? I said, Trevor, instead of 6.125, let's go to 6.5% on that same loan. That's just sort of reverse engineering the points, because the lender at that point is going to be able to give him back $3,000 after they pay my commission. They're still going to give him $3,000 back against his closing costs, which put him in a sweet spot of where he could afford out of pocket. So it was $75 more per month, but he was also saving $3,000 up front to pay for lender fees and appraisals and title work and all the traditional third-party fees. And he thought that was a great strategy. He could handle the extra $75 a month, but he couldn't handle the $3,000. So that's the way we're going to structure that one. On the reverse side, I said, look, you could buy that. I was just giving an example. I said, I can get you 5.5%, but it's going to cost you $7,000 extra. So we're able to go from 5.5, cost him $7,000 extra, to 6.5, which he's getting $3,000 back. So there's always a way to manipulate some of the fees, either through seller concessions. In this case, he didn't get any seller concessions from the seller because he offered a fairly low price for the property, but he was able to, because of the way we were structuring the loan through FHA, is to get him a better deal financially where he could afford to get in there. So again, that's something you may want to talk to your lender. Most people think they just have one rate. There's not just one rate. There's maybe one par rate every day, and that could fluctuate daily. But from there, you can manipulate the pricing structure. Another thing we've been doing over the years, a lot of is called construction to perm. Construction to perm is where you're building a property. I'll give you an example. I'm doing a loan for a man who's selling his house currently. He's going to take his equity, and he's going to be buying a piece of property out in Liberty Hill. He's buying a lot, basically. And he's using that. He's around $200,000 for the lot. It's a couple acres. Maybe I think it's in Liberty Hill. Maybe it's Bertram, but anyway, somewhere out there, he's going to buy a lot for a couple $100,000, a couple acres, and that's going to be his down payment on the new construction. So what we're going to do, he wants to build a barn-dominium. He wants to have, he's going to build a shell and then build it out. It's a barn-dominium, which is fairly common these days. And so we're going to be able to do what they call construction to perm, where we're doing a one-time close, where we're handling the construction note on the loan and the permanent at the same time. So let's say it takes 4 or 5 months to build his home. We do a construction loan up front and giving draws to the builder as they go. And at the end, when it's complete and he's able to move in, then we roll it into a permanent loan. That's called a construction to perm. So if you're looking to build a home, a custom home, in this case, the barn dominium, but if you're building a custom home, you may want to talk about this strategy with your lender. Usually the banks won't do it. A lot of times the banks will do construction financing, which is fine. Sometimes I refer banks construction loans. And then they'll come back to somebody like me for a permanent financing. That's called a two-time close. But a one-time close is you close one time, the money's held by the lender, paid out to the builder over time, and then they convert it. You don't refinance, you just convert it to permanent financing based on the initial agreement. So that's a very popular also structure if you're building a new home. Now, I want to talk a little bit about during the process, because everybody's concerned about interest rates, which is a very normal consideration. I'm concerned about interest rates. I've bought several homes. It's always a big factor in my decision. But what we can do as a broker, because I'm a mortgage broker, I have lots of different outlets. Now, they don't all allow this, but most of them will, where it's called a float down option. So let's say you come in and we lock your rate at 6% as an example for 30 days or 45 days or however long the contract is to agreed on. So let's say it's 30-day close and you're at 6%, you're happy with the numbers, you're protected against the high side. Your rate can never go higher than 6% within that 30 days. Now, it looked like we may need more time, then I'll say, hey, let's lock for 45 days. And usually the longer the lock, there's a little premium to those longer locks. So let's assume for a minute it's 30 days. If rates were to dip down to, let's say, 5 3/4 during the loan process, I can float it down one time before closing with no fee to the borrower. Okay. A lot of lenders don't allow that, but some do. And I usually work with the ones who have competitive rates up front and will also allow, the float down if in fact rates do come down. And we're always testing that because rates are so over the board these days because of this war in Iran. They've popped back up. We believe that once that's sort of settled out and the oil prices start to come down, inflation factors will come down, rates should come down a little bit more. We don't know that for a fact, but it doesn't hurt. It doesn't cost anything either. So it doesn't cost you anything up front. It doesn't cost you anything if we do it. So you can get a one-time flow down. It can't be, every other day. But it's a good tool to make sure that you should talk to your lender, whether it be a bank or me. Speaking of me, I want you to, if I can help you anyway, call me. My number is 512-789-6967. My company is Texas Mortgage Source. My banner's in the back. I've been here 40 years providing home loans. I'd love to work with you, whether you're looking to refinance or build a home we're talking about, or just purchase a home or investment property too. We're going to talk about in just a second. Now, that conversation leads into another option for folks who are building, let's say, a custom home that may take up to a year. Some of the large custom homes, sometimes even over a year. But you can also protect that lock. You can do an extended lock where they may charge 1%. So let's say you're borrowing $1 million to build a home, a nice custom home, may take a year to build out. You would put up $10,000 up front, and the the mortgage company would give you an extended lock for a year. So if rates were to go up, then you're protected for that first year. And again, if they went down, then they could renegotiate a better deal for you before closing. Usually within 60 days before closing, they can start looking at some different options for you. But it is peace of mind knowing that if rates went from 6 to 7 over the next year, you're going to be protected. That's called an extended lock. And again, most lenders will allow that. Certainly the custom builders will for sure, because it's very common. Now, I want to talk about a category of loan which is it's becoming more and more popular, and it's termed non-QM. QM stands for qualified mortgage, and that's something that was initiated by the federal government after the crash of 2009, 2010. They have this idea of a qualified mortgage, which is your traditional financing, full documentation, tax returns, pay stubs, W-2s, all the bells and whistles to get a traditional loan, which I've been doing for 40 years. Non-QM is a sector of the market that doesn't go through the normal channels of the secondary market. They're usually done by banks or large mortgage companies too that will securitize these loans and sell them at a little bit of premium rate. But they're not as conservative or strict as what they call the QM or qualified mortgages. They have different guidelines, which a lot of people are attracted to, especially people like self-employed or investors. I'm working with a man now. He actually lives in Poland. He has a home in Houston. He lives here in Houston when he's here, but he lives typically in Poland. That's where he's from. But he owns a property in Round Rock. free and clear. He rents it out, has been for years. So his daughters live in Austin, and one of them called me. She said, "Hey, Mark, we want to leverage some of that equity in Dad's property. It's his home. It's not theirs, but they've talked about it, and they want to take some money and buy another property, okay, using the cash out from his current loan." So it's called a DSCR, and I'm doing a whole YouTube videos on DSCR, and it's really quite simple. We don't look at the qualification of the borrower. They have to have decent credit, but we don't care about income. We don't care about their assets. We only care about the property. So in fact, that this property, because one of his daughters is a friend of mine, she's a realtor, and she said it should be appraised for around $400,000. Okay, and it rents for $2,400 a month. Currently, we have a current lease for $2,400. This is called a DSCR, debt service coverage ratio, which means that if we take cash out, we want to keep the payment at about the same amount as the mortgage payment. So we were able to get her $250,000, which related to about a $2,400 a month payment, which is a 1-to-1 ratio. What your payment is versus what your rent is, a 1-to-1 is what the lenders want. And I was able to give him 6.75% rate on that, which is phenomenal because he's got great credit. But he didn't have to come in and qualify the normal, the normal ways with tax returns and all that. And he's up in his 70 years old, and he didn't want to mess with all that. And I said, look, we're going to go with this non-QM option. You pay a little premium on the interest rate, but not a lot, maybe a quarter, 3/8, but it reduces a lot of hassle. Now I couldn't loan him $300,000 because then the payment would be higher than his rent. We could still do it, but the interest rates are much higher if you go under this 1-to-1 ratio. So if you're looking to buy investment property, that may be the way to go, especially if you're self-employed and you write off a lot on your tax returns and you don't have the income, at least for the tax returns, to qualify. This is a way a lot of investors are enlarging their portfolios, because if you put down 25%, you basically can get a mortgage without all the details of financing that we have to go through typically when people are buying conventional or FHA or VA or whatnot. So that's something you certainly want to talk about. Or another option, I'm doing a loan for a woman who bought a business about a year ago. She was a banker before this. She was on salary with a bank in New York. She's from Austin. She moved back to Austin and she bought a business. Now, she hadn't owned the business for more than 2 years, so we don't have 2 years tax returns. But what we do have, because it was an existing business, we have strong cash flow. I mean, she's cash flowing in this business. It's a nail and salon business, about $80,000 a month. Her revenue last year was over $1 million gross revenue. That's not what she netted, but that's what she earned as gross revenue in that business. We can prove that through 12 months of bank statements. So that's called a bank statement loan, which is another option. And this is going to be owner occupied. She will live in this condo downtown, but we can take a percentage of her gross income from her business as her income, even though we don't look at tax returns and all that. So it's another way of structuring these loans. Now, our rate was 7% versus 6.5%. But at that point, we didn't really have any options because she had only filed 1 year of tax returns. And on conventional, you're going to need 2 on a new business. So now next year, she could refinance it because she'll have her second year. We could go traditional Fannie Mae. So that's another thing that we have in the portfolio is bank statement loans, DSCR loans, 1099 loans, all sorts of different options on that for self-employeds. And another one that we don't see too often anymore, but we still have some lenders that will offer what we call IO, or interest-only payments. So if you borrow $300,000 and you pay 6%, as an example, interest only, that's $18,000, $1,500 a month. It's simple interest based on the loan amount that you borrow. And this is exactly what we're doing also with our client in Round Rock who's taking the cash out. We're looking at an interest-only option to keep the payment out. They want to maximize the out-of-pocket, so we got to keep the payment down as low as possible. And this probably saves $150 a month or so, maybe $200 a month, doing the math, and it's going to save them. It's going to get them another $15,000 or $20,000 at closing because we were able to do an interest-only loan as opposed to a fully amortized loan. The other option they're looking at, we haven't decided, is a what they call a 5/6 ARM, where the payments are lower for the first 5 years. In this case, 6.25 on an investment property, which is unheard of with no points. And after 5 years, they don't pay it off or sell the property, they're going to have to look at an adjustment on that rate unless they, again, refinance. So there's all sorts of ways of of looking at loans these days. And we talked about this a minute ago as temporary buy downs. That's really something that's still very popular um, in financing right now because of the way the market is. A lot of 2-1 buy downs. Did close one last week. It was a previous client of mine. He was moving from Shady Hollow up to Steiner Ranch. He was buying a house for about $1.2 million, and he was able to put down. He really could just put down 10%. No, it wasn't $1.2 million. It was $1.05 million, and he was able to put down actually 5% down. And what we did with him, Sean, is we did a first lien and a second lien. Okay, to cover the 95%. It's called an 80-15-5. He was able to put down 5% on a property over $1 million, very strong income, very well qualified as an attorney. And we were able to do a fixed rate on both loans, one at 6.5 and one at 7. The second lien was priced about a half point better, but he said, Mark, I get a bonus every year of around $200,000. I'll pay that thing off next year. He said he loved the idea because there's no mortgage insurance. We avoided mortgage insurance. And the seller paid for a 2-1 buy down for him, which got his payments well within his budget. So again, I just want to come on today and just kind of share a few things that you may want to think about if you're looking to buy this year or refinance even. Some of these are going to be free refinance strategies too. And again, if you got any questions, call me, 512-789-6967. Appreciate you being on, and we'll see you next week. See ya.